Um, in many cases, when companies are going through a difficult period, a lot of times it really depends on the management ability to turn it around. Can you, apart from this lady, Gina Reinhardt, apart from her, can you talk a bit about the management and with all the strategies that are in place? Have you, read about the management? I don't know if you've met the management. What is the sense of them doing anything about it, number one? And the second question, despite your very negative view of the company, your analysis shows that your cash flow is actually turning positive in 2012 and fairly steady for the next couple of years on cash flow, free cash flow, and the margins remaining fairly firm. Why is that so?
Thank you for your question. Now, with regards to the first part of your question about management, an interesting feature about Fairfax in the Australian media environment is it has one of the most volatile management structures on the market. Fairfax is something like 5 CEOs in the past 6 years, and they've come from a variety of backgrounds. Journalism, online, some externally and internally. Now, with regards to management strategy, Fairfax right now does not really have a very coherent or dynamic managerial strategy. A strategy. Right now, Fairfax is trying to rapidly adapt to a media environment that is going digital. And unfortunately, Fairfax has done a little bit too little, a little bit too late. Now, if you wind back the clock 20 years, Fairfax was a big player on the Australian media market for 2 reasons. It had 2 clear sources of competitive advantage. Firstly, it was heavily invested into capital expenditure and physical supply routes. So it had one of the lowest per unit costs on the entire market, giving it a significant margin advantage over its peers. Secondly, Fairfax has been around for 170 years. So the drawing power of its mastheads is very significant, and that continued to draw in a lot of advertising in terms of classifieds and transactions. Nowadays, when Fairfax is going digital, a lot of Fairfax's traditional sources of competitive advantage are now obsolete, and management realizes this, and they're trying to adapt. But they've done very little, and they've done it very, very slowly. For example, in terms of Fairfax's physical assets, in terms of its printing presses, the Australian media environment now is in a state of overcapacity. And rather than serving as a source of competitive advantage, Fairfax's printing presses now serve as actually a barrier to exit by continually locking in very, very high costs. And management has tried to get rid of these print assets through a very ambitious program of print rationalization involving a joint venture with News Corp. But what Fairfax may or may not realize is that News Corp controls 70% of the Australian newspaper market. And the other 30% is divided up between Fairfax and a few other competitors. So this strategy in itself is highly, highly risky. I mean, even if it doesn't go through, Fairfax will feel the most pain. Now, in terms of migrating Fairfax's brands online, management has also done very little too late. Going online, Fairfax, rather than digitizing its existing mastheads, it's gone and adopted a very ambitious acquisition-based strategy. But rather than target the category leaders in the Australian media market, Fairfax actually built up a portfolio of second-rate online brands. Now, this might be a viable strategy overseas, but one particular characteristic about the Australian online market is that there are very few advertisers and their purses aren't that big. So you typically find that advertisers want to stick with the market leader and just run with the market leader. They don't have a lot of expenses to disperse across multiple providers. So in the Australian market, second really is the first loser, and Fairfax is a strong second. For example, in Fairfax's print media, you'll typically find that Fairfax's competitors have a margin of at least 20 or above in terms of audiences. In terms of Fairfax's online brands, Fairfax frequently touts its advantage in terms of its unique audiences. I think Fairfax's flagship masthead has something around 2.9 million unique audience annually. But what Fairfax doesn't realize is that its competitors have multiple websites. For example, take News Corp. The top 2 websites of News Corp combined have an audience of around, I think, 3.5 million. That's just a print story in terms of media. In terms of advertising, the situation's even worse, and online transaction marketplaces. An interesting thing about the Australian media landscape is that it's dominated by a lot of single platform killers. right? You've got a company that's dedicated solely to employment, solely to real estate, solely to car sales. And typically you'll find that these single platform killers have a unique audience base of 2 to 3 times that of Fairfax. So why would anyone want to transact with Fairfax when you can get 3 times the listings on another platform, or you can get 3 times the people viewing audiences? So coming back to your initial question, managerial strategy, it's volatile, it's short-term, and it's reactive. Buy a lot of second-rate brands, hold your hands together, and pray for the best. And this hasn't worked out for Fairfax. And sorry, could you please remind me of your second question?
Yeah, with the second question regarding cash flows and margins, we forecasted that revenues will decline at a compound annual growth rate of about -2%, and margins have fallen by about 20% across the forecast horizon, from 25%, well, EBITDA, 25% to 20%. Profit margins have fallen from 12 to 5%. And the reason why cash flow has been negative for the past few years is because Fairfax, again, went on this debt-fueled acquisition phase between 2006 and 2009, and they've now gotten to the stage where they're writing down a lot of their goodwill, a lot of their intangibles, and a lot of their assets as well. So that's why there's that negative cash flow. And going forward, we expect that Fairfax has written off most of the poor acquisitions that they've made, and basically there won't be as many asset write-downs and etc., which would affect the final cash flow figure.
I realize that your target price 0.72 are comprised with 30% consolidated DCF and 70% SOTP multiples. And can you share with me why 30%, 70%? And after you calculate the target price, do you feel it's a little bit too high, given that all your arguments on the company weakness?
Okay, so ultimately, I mean, that 70 to 30% weighting, intuition does come into it. You have to make some sort of judgment call. Ultimately, in a multiples method, if you look at the PE ratio that we use, it's implicitly driven by risk and growth. However, our qualitative insights about the structural decline of print, and we investigated and found that an ad, a real estate ad in the Sydney Morning Herald, a print broadsheet, costs $3,500 per month. Now, online, the same ad on domain.com.au, the online real estate classifieds area, was $375 per month. And this 9-to-1 profit destruction ratio is a qualitative insight that we felt that the multiples method simply could not reflect. That's why we weighted this DCF method at 70%, because we feel that those structural risks going forward, which Fairfax is going to have to contend with, could best be reflected through that method. Ultimately, there is some degree of standard error in the estimates such as beta, the terminal growth rate, and we performed a scenario analysis and a Monte Carlo analysis to help alleviate some of those concerns. Also, from triangulating from those two valuation vantage points, the sum of the parts multiples method and the DCF, that also helps alleviate some of those standard errors in the DCF method.
And a further point is that our investment horizon is only 12 months, and in that 12 months we believe that there's a possibility that the share price will not actually fall to our intrinsic value from the DCF, which is why we incorporated partly, well, 30% of the multiples analysis, which is more market driven. And also we only gave the multiples a very low weighting because many of the comparable companies are not truly comparable to Fairfax. Fairfax has been diversifying across audiences and across platforms, but they still remain very much in the print arena and are just barely diversifying into the online arena. Whereas a lot of its competitors, for example, Seven West, they merged back in 2000. They merged a couple of years ago, and essentially they are now a 50% print and a 50% television company. And even overseas media companies, for example, the Daily Mail, only 50% of their revenues are tied to print, whereas for Fairfax, it's 72% of the company's value is related to print in some way. And that's why we feel that if we just used multiples or gave greater weighting to multiples, it would end up overvaluing Fairfax due to the fact that Fairfax's fundamentals are a lot worse than its comparable companies. And having said that, we do believe that our DCF valuation is more in line with what the intrinsic value of Fairfax would be, but we had to incorporate this multiples method mainly just to account for the fact that our investment horizon is only 1 year, and in that 1 year, share price might not fall to that intrinsic value because of market factors.
if you were given the management of this company today, what's the first thing you would do to turn around?
Thank you.
Thank you very much.